My name is Kailveli Selvarajan. My metric number is 10DIB19F2040. I'm explaining about question 1. The first question is justify the value of Zidane Corporation. The formula is value of levered firm equal value of unlevered firm equal to EBIT and then divided by WACC. The answer is 35,000 divided by 0.5 and the answer is 70,000. 0.5 is 50%. How we get is from the question that given F equal proportions of debt and equity. The second question is search the cost of equity for Zidane Corporation. The formula is RE equal in bracket RA minus RD, another bracket debt divided by equity. The answer is 0.5 plus in bracket 0.5 minus 0.10 and then another bracket 9,000 divided by 61,000 and the answer we get is 55.92%. The conclusion is the expect income 35,000. From this amount, 9,000 times 10% is paid to debt. Thus, 35,000 minus 900 is paid to equity holders.
Hi, my name is Shafiqah binti Muhammad Shokri, no metric 10 DIB1 dan F2022. I will explain about the trade of theory. The trade of theory mean of the capital structure is a theory of the capital structure of firm. The theory tries to balance the cost of financial distress with the taxable benefit from using debt. Under this theory, there exists an optimal capital structure that is a combination of debt and equity. In fact, the trade of theory lacks a number of assumptions under the capital structure irrelevant theory. The trade of theory starts from the capital structure irrelevant theory but relaxes one of the assumptions. The theory removes the assumption that there are no costs to financial distress when the company borrows more money. If we remove that assumption, then taking one more debt does not necessarily lower the WACC. Instead, there will be a point at which the additional value added from taking on more debt is exceeded by the value reducing cost of financial distress. This point is the optimal capital structure and it is the point where the value of the firm is maximized. The statistic trade-off theory formula looks as follows. VL equal to VU plus TD PV, where VL is the value of the leveraged firm, VU is the value of the unleveraged firm, T is the marginal tax rates, and D is the value of the debt. In the following figure, we show the relationship between the cost of capital and the percent of debt in the capital structure. We see that the after-tax cost of debt has an upward slope because of the increasing cost of financial distress. As the cost of the debt increases, so does the cost of equity. The optimal point is where the marginal benefit of the tax shield equals the marginal cost of financial distress. I will continue about the pecking order theory. The pecking order theory is the capital structure is a theory in corporate finance. The theory tries to explain why companies prefer to use one type of financing over another. The main reason is that the cost of financing trend to increase when the degrees of asymmetric information increase. The pecking order theory is one of the most well-known capital structure theories. The provides an explanation of capital structure companies is dominated by debt. The theory was first proposed by Mears and Majors in 1984. The pecking order theory or pecking order model states that the cost of financing increase as companies use source of funding where the degrees of asymmetry information is higher, As companies raise more and more capital, it becomes increasingly hard to obtain such funding externally. Instead, they are forced to them to resort to bank debt and public equity. This source of funding tends to be more expensive. The pecking order implied by the theory is the following. Companies will prefer to use external financing first, second debt, and finally equity. Thus, raising new equity is the option of last resort. Pecking order theory example. As an example, pecking order consider a company that has a project of 50 million which is need to finance. It can use 10 million of the internal financing which is currently on a current account yielding no interest. Thus, this is the cheapest source of funding since no risk premium has to be paid. Second, the company can also raise debt. If the company raises debt, it will have to pay an interest rate of 6%. Finally, the company can also issue new equity. The required rate of equity is 12%. Clearly, equity holders have a residual claim. Thus, they require a higher rate of return than debt. Still, even if the required rates of return on debt were the same, a company would still prefer debt. This is because issue new shares would be encrypted by investors as a sign that the stock is currently overvalued. This explains why companies typically use considerable amount of debt and prefer debt over equity.
Hi, my name is Nurul Akila binti Mustafa. My number card matric is 10DIB90F2024. Today I will talk about financial distress. Financial distress is a situation in which an organization or any individual is not capable enough to honor its financial obligation due to insufficient revenue. It is usually because of high fixed costs, outdated technology, high debt, improper planning and budgeting, and improper management leading to insolvency or bankruptcy. After this stage, the company becomes insolvent. There are very few chance for a company to survive after it reaches this stage. The organization has very low liquidity as it cannot repay loan installment in interest, payment to supplier, even salary to its employer. If the organization wants to survive, it needs to lower its costs, restructure its liability, and revise business strategy. After that, I will talk about description. Firm experience increased costs of hardship not only face potential bankruptcy, but also lose profit when management become preoccupied with a darkening financial picture. Employers show lower productivity because they are worried about their job. Supplier charge more upfront money for goods and service that invoicing or extending credit, and customer find a healthier company to do business with. In this sense, the cause of hardship can lead to vicious cycle depending the level of hardship. Company experience financial difficulty may find it difficult to obtain financing. They may also find their market value and stock price drop significantly, customer reduce order, and corporate robber surround themselves. Formula of financial distress. When the company is distressed, its asset don't cost more and its debt become more expensive. The rate of interest charged by the bank to the company is higher than what is charged to the other company in the same industry. First, calculate the weighted average cost of debt. Second, take the cost of debt of rate company. Next, I will talk about financial slack. Financial slack is the unused debt capacity. Business go through various conditions in their lifetime. There are times when the company earn high in income, which can be termed as profit or growth or revenue. On the other hand, some company may go through a downturn in sale, profit or revenue. In order to sell Through the condition, a company must have extra money. This extra money can be used when the company is in trouble, is known as the financial slack of the company. Financial slack is the untapped debt potential of the company. It may be availed from unused debt capacity, unutilized line of the credit, excess liquid asset, and various other sources of cash. Slack is an important measure to the debt capacity of a company. If a company uses all its debt capacity, the amount of the financial slack will be zero. In such condition, the company will be unable to meet unexpected costs that may be necessary for the good health of the company. In many situations, financial slack also referred to as the unused debt capacity of the company. The unused debt capacity is an amount of debt a company can source for use in various investment projects. It is useful because companies usually need money to grow or expand. The financial slack help company to do in time of need. Formula of financial slack. Available slack is a measure by two indicators: current ratio and level of working capital. CR is current ratio, calculate as current asset, divide by current liability, and measure available slack by liquidity. Current ratio measure firm liquidity comparing available liquid asset to short-term financial need.